Bill Gates has amassed a massive net worth of over $120 billion. While most people know that this incredible amount of wealth was created through his founding of Microsoft, what most don't know is that Bill Gates has been able to continue to grow his net worth through his favorite form of investing, dividend growth investing. In fact, Bill's approach of dividend growth investing has allowed him to double his net worth from 2000 to 2022, going from a net worth of $60 billion to $120 billion. While the ETF Berkshire Hathaway is the largest holding in his portfolio, he still seeks out individual quality dividend growth companies to invest in. In this video, we're going to be looking at the top 3 dividend stocks in Bill Gates' portfolio. These stocks are the top holdings in his foundation's fund. To analyze these companies, we're going to be jumping into my stock valuation spreadsheet to see if we can calculate their intrinsic value and decide if now is potentially a good time to consider buying. If you'd like to be able to download the spreadsheet used in this video, then you can head over to my Patreon page at the link in the description. The first and largest holding in Bill Gates' dividend portfolio, not including Berkshire Hathaway, is Waste Management. This is a company that takes up over 16% of Bill's dividend portfolio, meaning he has $2.8 billion of his net worth tied up in this company. And we can see over the past 5 years, really good returns of over 100%. We can see year to date, they're only down 4%, which compared to the broader market as a whole over that time is pretty decent. Now, jumping into my stock valuation spreadsheet, we're going to be looking at 4 different valuation models for this company. We'll be looking at Graham's valuation, a discounted cash flow model, a multiples valuation, and our dividend discount model. So let's go ahead and jump over to our stock screener. If we come up here and plug in the stock ticker WM and hit enter, we can see this data is going to all automatically load in. Now, the past 365 days for this company have been a little bit choppy, as we can see right here. The company currently has a dividend yield of about 1.66% and a payout ratio of 47%. Analysts currently have a target price of about $174 per share, and the beta is 0.75, so you shouldn't see a whole lot of volatility. Now, jumping into our first valuation model, which is Graham's valuation, I'll go ahead and zoom in here. And this is a valuation model invented by Benjamin Graham, one of Warren Buffett's mentors, and here's the formula he lays out for us to calculate intrinsic value. You can see we're plugging in our earnings per share, we're adding a growth rate projection, and also looking at the current yield of AAA corporate bonds. And once we plug all of these numbers in, we come to an intrinsic value of $99 per share, which is actually quite a bit lower than the current trading price for this company. Now, a big driver of this valuation is the current yield on AAA corporate bonds, which is the highest it's been in many years, leading to a lower valuation. Earlier this year, it was as low as 2.8. So if it was 2.8 right now, we can see we'd come to an intrinsic value of $172 per share. So the current market conditions are definitely playing a role in this valuation. Now, moving forward and looking at our discounted cash flow model, I think this is one of the many reasons a lot of people love this company. We can see the historical free cash flow for this company has been growing for quite some time. It's had an average growth rate over the past few years of about 12%. Moving forward, we're projecting a growth rate of about 14% due to industry expectations and analyst expectations. So I'm projecting that 14% growth rate to the future free cash flows, finding their present value and adding them together here, added the company's cash and cash equivalents, subtracted out their total debt to find their equity value, divided by the shares outstanding, and this gave me a discounted cash flow price per share of $180 per share, a very good valuation for this company. Now, moving forward, we're looking at our multiples valuation, and the idea behind this valuation model is we should be able to value a company by seeing how the market is valuing companies that are similar in structure using a multiple such as our price to earnings multiple. So we're taking similar companies, looking at their stock price, dividing by the earnings per share to get their price to earnings multiple. We then take the average price to earnings multiple for those companies, multiply it by Waste Management's earnings per share to come to an intrinsic value of $157 per share. And if we jump back over to our stock screener, we can see they're currently trading $156 per share, price to earnings of 30.55, and the average price to earnings of their competitors is 30.8. So that you can see this is a company that is valued very similar to its peers according to the price to earnings multiple. Now, moving forward and looking at our last valuation model, the dividend discount model, this is one of my absolute favorite ways to value a company at times because it values them based on how much they pay out in dividends and how much that dividend is increasing over time. So you can see I plugged in the quarterly dividend payouts for this company so we can see how much they pay out each year, and this allows us to see year-over-year growth rates of 10.3, 6.2, 5.5, and 13%. That gives them an average growth rate of about 8.8 over the past few years, a very decent and good dividend growth rate. Now moving forward, I'm projecting a growth rate of about 7%. After applying our discount rate of 8.5%, we come to a dividend discount model price per share of $185 per share. Now, anytime you have a company that does have a high dividend growth rate, there's a couple of different things you want to check. First, we want to jump back over to our stock screener and look at that payout ratio, which is currently sitting at 47.6%. That's a pretty decent payout ratio, meaning the dividend is safe. But we also want to see growing free cash flow, which we jump back over to our discounted cash flow model. We can see that is the case. So this is a very safe dividend paying company. They should be able to increase the amount they pay out in dividends for many years to come. Now, jumping over to our output page, we can see all four of our valuations: Grams at 99, multiples at 157, discounted cash flow at 180, and dividend discount model at 185. And when we average all four of these together, we come to an intrinsic value of $155.64. Now, we always want to apply a margin of safety to our investments as a value dividend investor. So let's say I apply a 20% margin of safety. Based upon that, our acceptable buy price is $124 per share, meaning it's not quite in the range that I want to buy at. This is a company I've had on my watch list for quite some time. I would really love to add shares of this company to my dividend portfolio, but I would like to see it go a little bit lower. Now, there are still a lot of people who feel comfortable buying it at this prices because the free cash flow growth and dividend growth is so good, but for me, I'd like to see it go just a little bit lower. But let's go ahead and move on to our next company. The second largest holding in Bill Gates' portfolio is Caterpillar, stock ticker CAT, currently trading at $179 per share. This company takes up about 7.4% of Bill Gates' dividend portfolio, meaning he has about $1.3 billion of his net worth tied up in this company. We can see year to date, they're down about 13.16%. Now let's go ahead and jump over to our stock valuation spreadsheet. We'll plug in their stock ticker and hit enter, and this data will load in. Now, out of the three companies that we are looking at today, this one has the highest starting dividend yield at 2.67%. They have a nice, safe payout ratio of about 35.3%. Analysts currently have a target price of $207 per share for this company. It has decent institutional ownership at 71% and a beta of about 1.03, meaning the volatility should be pretty close to that of the market, but they also have a very high market cap as well of over $94 billion. Now moving forward, we'll look at our first valuation, which is going to be Graham's valuation. And we can see here the formula again that we're using. Again, this current yield on AAA corporate bonds will drive down this valuation, but due to the high growth rates for this company and the strong earnings per share, we still come to an intrinsic value quite a bit higher than the current trading price, as we can see right here, of $214 per share for their intrinsic value. Now moving forward and looking at their discounted cash flow model, we can see historically over the past few years, they do have a good average growth rate of about 11.4%. Moving forward, I'm projecting a 12% growth rate for their future free cash flows, as we can see here. I'm then taking the present value, adding the company's cash, and subtracting out their total debt. And after we divide by our shares outstanding, we come to a discounted cash flow price per share of $269, as we can see right there, which is a good bit higher than that current trading price. Now moving forward and looking at our multiples valuation, you can see the companies I'm using as the comparisons for them right here. They have an average price to earnings of about 14.14. Now jumping over to our stock screener, we can see the price to earnings for Caterpillar pretty close to that, 14.39. which means it's going to lead to a valuation very close to its current trading price. We can see we come to an intrinsic value of $175 per share, current trading price $179. And looking at our last valuation, again, one of my favorites, the dividend discount model, we can see I plugged in the quarterly dividend payouts right here to see how much they pay out each year. This company has had really good dividend growth a few years, as we can see here, of 19.7. From 2020, it looks like they didn't increase their dividend any. Then they had a year of 7.7 and 8.11. That gives them an average growth rate of pretty close to 9%. Now, you never like to see a company not increase their dividend, especially when you're investing solely for dividend growth over time. But overall, this is still a very good dividend growth company, a good average growth rate right here. So I am applying a 7% growth rate. I think that's sustainable, as we saw with our payout ratio and growing free cash flow. With a discount rate of about 9%, we come to a dividend discount model price per share of $256 per share. Now jumping over to our output tab, we can see all three of our valuations: Grams at 214, multiples at 175, discounted cash flow at 269, and dividend discount model at 256. So when we average the four together, we come to an intrinsic value of $229 per share. So let's say we want to apply a 20% margin of safety. Based upon this, we can see our acceptable buy price would be $183. So our spreadsheet is giving us a signal to buy this company. Now, for me, I actually do already already own this company. I added shares recently because I really like the value for the company. I love the starting dividend yield for a dividend growth company like this. Well, let's go ahead and move forward and look at our last company. And the third largest holding in Bill Gates' portfolio is Ecolab Incorporated, stock ticker ECL, currently trading $142.70 per share. This company takes up about 3.8% of his portfolio, meaning he has $671 million of his net worth tied up in this company. And we can see over the past month, they have taken a huge dive down over 18.15%. So let's go ahead and jump into our stock valuation spreadsheet. We'll come up here and plug in our stock ticker and hit enter. And we can see they have a fairly low starting dividend yield of about 1.43% and a payout ratio of about 51%. Current trading price, again, $142 per share. But if we look at our 365-day chart here, we can see there's been a huge decline over the past year, not just the past month. Now, analysts currently have a target price of $178 per share. And I was very surprised to see institutional ownership around 90%. That's very high. Now, this company has a beta of about 1.02. So again, you'll see volatility levels pretty close to that of the market. Now, moving forward, we will look at Graham's valuation. So I'll zoom in here. Again, we can see intrinsic value according to Graham's valuation of about $67 per share. That is a lot lower than the current trading price for this company. Obviously, again, current yield on AAA corporate bonds is pushing that down, but the low earnings per share for this is going to hurt that as well. They do have a good growth rate projection, but again, that earnings per share needs to be a little bit higher if they want to get a higher intrinsic value with Graham's valuation. Now, moving forward and looking at our discounted cash flow model, they haven't had a whole lot of free cash flow growth over the past few years, but analysts and industry expectations are still relatively high for this company. So I do feel comfortable applying a growth rate of about 12.5% to the future free cash flows for this company. I then obviously took the present value, added those cash flows together, added the company's cash, and subtracted their total debt to find their equity value. And after dividing by our number of shares outstanding, we came to a discounted cash flow price per share of $131 per share, again, slightly below that current trading price. Now, jumping forward to our multiples valuation, you can see the companies I use as the comparison here. We then took their average price to earnings multiple, which all of these companies do have relatively high price to earnings multiple. The average was about 37. After I multiplied that by ECL's 3.8.3 earnings per share, we came to an intrinsic value of $142 per share, meaning that their trading price is pretty much even with their multiples valuation model. Now, looking at our last valuation, the dividend discount model, obviously dividend growth is going to be extremely important for an investor like Bill Gates. We can see this company has unbelievable dividend growth over the past few years, a year with 31%, 18.6%, 23.3%, and 9%. That is absolutely unbelievable. That's the kind of dividend growth that's going to allow investors to end up with dividend yields on cost as high as 50 or 60% like Warren Buffett. That's an average growth rate over this time period of over 20.5%. So moving forward, I am projecting a growth rate of about 7.5% for them and a discount rate of 8.5, leading to a very high dividend discount model of $258 per share. And so when we jump over to our output tab and average all four of these together, Graham's at 67, multiples at 142, discounted cash flow 131, and dividend discount model at 258, we come to an intrinsic value of $149.88. Now let's say we want to apply a 20% margin of safety. Based upon that, our acceptable buy price would be right at $120 per share. So it's not quite at that acceptable buy price, but there's a lot of people really drawn to this company just because the dividend growth has been so unbelievable over the past few years. So if you want to make a good value investment, maybe you want to wait for it to go a little bit lower, but if you're comfortable with this company, you like the business model, and you really are looking for long-term dividend growth, this could be a potential good investment. It's definitely a company that I'm going to keep on my watch list. So those are the top 3 dividend stocks in Bill Gates' dividend portfolio. This dividend growth investing strategy that Bill uses allows him to compound his wealth over time at massive rates, and it's the same strategy that I use in order to one day allow me to live off of my dividend income. If you'd like to be able to download the spreadsheets using this video, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.